Hi there, and welcome to another one of Livewire's CIO interview series. My name's James Marley. I'm a co-founder of Livewire Markets, and my guest today is Chad Slater, Co-Chief Investment Officer at Morphic Asset Management. Chad's a regular contributor to Livewire, and he is a global investor. He has some really interesting views on the macro environment right now. He also has a great perspective on ethical investing and how this can be used to find good investment opportunities on the long and the short side. We'll also dive into some of the investment lessons that he's picked up along the way. Our conversation starts with Chad telling us about his early days working in Treasury. So let's get into it.
Well, there's not many of us who are actually economists who go on to become stock pickers. The normal course of action is an economist becomes a strategist, might work at an investment bank. Half my peers from the RBA became strategists. So when people think of economics, they normally think of what we call macroeconomics, which is how's the economy doing, etc. And that's very valuable. That's quite clearly relates into, obviously, if the US economy is growing, that's going to have an effect on earnings of all the companies that make it up. So there's a lot of what you call top-down insights you learn as an economist. But I think the most interesting area that I would never have thought of that I could apply is actually microeconomics. Like, I actually didn't even study microeconomics that much. I was more macroeconomist. And it turns out a whole pile of microeconomics relates directly to stock picking. That's the area I probably didn't appreciate as much.
So what's an example? Microeconomics that applies to stock picking, what is it?
Okay, so there's a couple of them. The first one you can think of is what's called oligopoly models. There's two things called Stackelberg and Cournot theory or oligopoly models. Stackelberg's what's called a leader-follower model. And guess which industry a couple of years ago looked exactly like this? Australian Airlines. Got two airlines, and a leader-follower model means you have a high percentage share in one and the other. But for that to work, you essentially need a theory, like a game theory model. And you need to signal, and Qantas had never signaled that they wanted to stop. So one thing that was really interesting why we got long Qantas at $1.20, we can talk about what we got wrong with that later, but was that they were signalling through the press, classic Cournot style and Stackelberg model oligopoly signaling, that they'd had enough of the price war. You don't need to collude, you can signal in certain ways. So that was one, and we actually wrote a piece up pulling in this theory. Unfortunately, we sold it at $2.20 thinking we were geniuses. That's another lesson in itself.
So you did your time at Treasury. What was the next move? How did you go from that position and get into funds management?
Well, I'd always wanted to be a funds manager, but there's not many graduate roles to go into. So the advice had been to go work as an economist from someone I trusted, James McDonald, who went on to become Deputy CIO at Hunter Hall. And I think it was excellent advice. I applied for the grad program at BT Funds Management. They were one of the few places in the late 1990s, early 2000s that had grad programs on the buy side. And I remember the HR lady going, you realise this is for new graduates, you've already got a job. And I said, this is the job I want. And she goes, well, we don't think you're going to make the final round of interviews. And I said, well, I'll apply again next year. And she's like, well, if you're that keen, actually come on down for an interview. So the rest is history. I got offered a role there. So that's sort of how I lucked into it, to be honest. Like, there was 2,000 people applied for those 5 positions. They did final interviews of 100 people. And then there was a grad rotation program of 20 people. So I was extremely fortunate, but you know, good outcomes are a combination of luck and preparedness, I think, in life.
You've gone on and set up your own funds management business with Jack Lowenstein, Morphic. Tell me, the process that you employ has a macro layer to it. You have a head of risk and someone in charge of looking at macro. A lot of the interviews that we do with fund managers, they tell me that they're purely bottom up. They're stock pickers, focus on the fundamentals. Why do you have that role for the macro person in your business?
Yeah, it's a good question. When you start your own business, you get a clean sheet of paper. So most people join firms that have existing processes and they have to adapt to those processes, and it either works for them or it doesn't. They get sacked and move on. When you're a clean sheet of paper, you think about, okay, what would I like to do? And this pulls back my experience as an economist. The reality is, and I've got a lot of respect for people who are bottom-up stock pickers only, but those stocks exist inside an economy. An economy is a sum of all those companies. It is difficult to say that that company operates in complete isolation to that. If you look at any quantitative analysis, about 70% of a stock return comes from everything other than the stock-specific outcomes. So whilst that matters, to ignore the 70%, I think does a disservice to investing. The hard bit is how do you take that and try and put it in a process? Because most bottom-up stock people aren't economists. They know companies, they know management. So trying to force them to actually become macro investors is a bad way to do things. I saw that in a number of firms that I worked at. Is to say, look, since we can't escape macro and it matters, let's make it a completely separate role inside the business. And then it feeds into decisions in the stock picking, and let's separate the stock picking from the macro role. Instead of saying macro doesn't exist, let's embrace it and try and figure out how to build it into the process. So ideally, what we do then is we find a good stock, and then Jeff and the head of macro role, the two line up. Good macro, good stock, in theory should work. Conversely, you like the stock, but you don't like the macro. That says you might want to consider hedging out some of the risk somewhere.
Yeah, interesting. Well, you've got some good horsepower on your advisory board with Jared Minack, who's obviously very macro focused. As we speak now, it's we're at a point where bond yields in the US have spiked to a high that I think has caught a lot of people by surprise, and we've seen selling in equities, particularly some of the high PE names, longer duration. What's your assessment and the assessment of your macro team and advisory on what's taking place in macro right now? How are you thinking about that?
Yeah, what's happening in macro, and we just actually had our weekly macro meeting with Jared Minack just today actually. And we sit down, and Jeff, as my head of macro, then brings it in. None of the stock team attends the meeting because we separate the roles. I don't want the stock people having opinions on these matters. They focus on stocks. Is the Fed, as we get towards the back end of the year, so up until last year, you made money by betting against the Fed. So the Fed never raised rates as much as they always threatened to do under Janet Yellen. For the first time, the Fed is on track to actually do what they say they're going to do. Now, there's this interesting quirk that happens where basically people have calendar years in their heads. So people are behavioural animals. And as they get towards year end, they start to think about 2019. So there's this quirk where the market reprices either against the Fed or to the Fed in the final quarter of the year. So what's happening is you see is that the Fed said that they're going to do 3 to 4 hikes next year, and the market had 1 to 2 in there previously. As we get towards 2019, the timeline of the Fed changing its mind now has compressed to a very low probability at the moment. So the market is being forced to the Fed view. So you're seeing the whole curve move up. So not just 2 years, but 10 years are moving. But 10 years are also moving a little bit quicker as people accept that, maybe real rates don't have to be below zero. So it's called the neutral, or the neutral Fed funds rate, is getting pushed into the curve. And why does this matter for growth stocks? Growth stocks are what you call long duration, which means you don't make your money this year, next year, or the year after. You're betting that in 5, 10, 15, 20 years, the growth pays off. I think Tesla's going to be, all the cars are going to be sold in the future. When you have something a long way away and you change the interest rate, it has much more sensitivity on today's valuation. Whereas if you own a mining company and you've got 10 years of mine life, changing interest rates has less effect on that valuation of the business. So that's why growth stocks are getting hit at the moment, is because these rates in the long end are going up at the moment.
It seems like the performance of these really exciting growth stocks and particularly this US leadership, this momentum trade has been, people have been wondering whether there's going to be a circuit breaker. You've written articles yourself about, is value investing dead? Is this change the reality of the spike in the long-term bond rate? Is that the catalyst that's required to see a shift back towards value and maybe a de-rating or a de-acceleration of the momentum that's been in those growth stocks?
Look, we're not a growth investing house. We're a value investing house, as you alluded to just before. But it is important to understand why growth has done well. Some of our peers in Sydney are just like gross overvalued, etc. We don't like that model, as in we prefer just to say, what are the numbers behind it? And growth has done well because it deserved to do well. So earnings of growth stocks have come in as in line, if not better than what people thought they would. So earnings of growth companies have actually done better than the earnings of value companies. Value stocks have not delivered any earnings. So the market has been right to not price value stocks correctly, or to not price them like they used to. The issue is growth stocks have gone up more than what they should have. So, and in particular, the early part of this year, growth stocks were going up despite interest rates going up, which shouldn't really work. And that looks more like, I'll use this word carefully, a bubble rather than true fundamentals. It also looks a little bit like 99, where value stocks actually lagged, and then you went into 2000 and the growth stocks sold off, but value stocks didn't go down very much. So with real interest rates going up, you'd expect value stocks to do better, but we are cautious that they just haven't delivered earnings.
So just against that backdrop, what are you looking for in this environment at a stock level?
So at a stock level, hopefully you would have some sort of defensive characteristics and some certainty of earnings. So there's factors in investing, which you call momentum, which is a trend, things that are going up. There's value, which we just talked about. There's growth, and there's also quality. Momentum is a weird factor. It attaches itself to any of the other three. So momentum can have value in it, momentum can have growth in it. At the moment, momentum is full of growth and expensive stocks. So we're looking for quality is actually not that expensive because quality doesn't have to be growing. So think of, I'm trying to think of a business here in Australia that doesn't have a high growth profile, but so think of Colgate-Palmolive actually in the US. It's a quality business, but it's just not growing very fast. Is to try and look for some quality with defensive characteristics. We find them predominantly in Japan at the moment. Everyone talks about the world being overvalued. I'd point out that Japan's on a PE of 13. Even if earnings are 30% less than what you expect in Japan, that's still less expensive than what the US current earnings are on. So we think we find businesses like that which are developed, not emerging markets so much, that have some of these quality characteristics to them.
Yeah. You're talking about some, buying stocks in some markets that are under pressure or have been out of favour for a really long time. We've seen the pressure that emerging markets have been in of late. What's the catalyst to see those markets start to perform really well? Understandably, investors are sceptical about going into some of these lesser performing countries at the moment.
Yeah, it's one of the hard things is that value investing is why it's a good strategy on average, not always, but on average, is that when you buy cheaper things, you have multiple catalysts. Jacob at Antipodes has multiple ways of winning. I think it's a great phrase to describe what works for value is if you have more than one way, and value means you have a margin of safety, to use the Buffett phrase. We think when you're buying things on 13 times earnings in an upgrading cycle, that you get paid to wait. Patience works in your favour if you get a good yield and earnings are growing. You don't need the market to reassess you right away. When you pay a lot for a stock, patience can serve you poorly. Because if it doesn't happen very soon and it's trading on a high PE, the stock will start derating on you. So I can give you catalysts like that. If people think GDP like later this year through next year globally is better than what they currently think it is, that should do better. If people come to appreciate that Japan's actually structurally reformed, it should come to do better. And in Asia ex-Japan, where we do have some other stocks, if people actually appreciate that the earnings downgrades this year have not been that large, there's a lot of money, I think, that can flow back into these things. But patience serves you well when you're a value investor.
Alrighty. Well, let's stay on the idea or the concept of finding ideas. You run a number of ethical strategies. What's one example of a really compelling investment opportunity in the ethical space? Yeah,
so ethical investing means your money, my client's money, will not be invested in things that they don't want. And normally, and for us, this is characterised by coal, oil and gas stocks, as well as tobacco, nuclear, firearms, etc. They're the main ones. So what we ideally look for is things that aren't in that space, that have some of the value characteristics and quality characteristics that we just talked about. A business that we really love at the moment, but it's coming under pressure at the moment, is China Water. China has one of the biggest problems is the water, even though it is actually spread in all the areas that people aren't located in. And they have one of the highest loss rates from water and sewage. And that's been traditionally done by state-owned enterprises, but they're not great at running sewage businesses. So China Water is one of the smaller listed companies there. And then what they're doing is they're working with third and fourth tier small Chinese cities to actually fix the pipes and plumbing. Not particularly sexy business. It's not like Tencent or anything like that. But it's a really necessary business, and they're very good at it. Oryx owns 25% of the business, so Oryx is a large Japanese corporate. We think they've got a large, long growth profile. It's a market cap of $1.3 billion US. It's under the radar. We don't think the Chinese are going to change regulations on water and sewage that much. It's just they want people to fix their water and sewage. These guys don't earn a excess return. They're not a threat to the Chinese Communist Party, whereas Tencent might be deemed as that. That is an ethical business that we like, that's quality and growing. It pays me a divvy yield of 3%, and it's growing its earnings at 20% a year.
Yeah, essential services.
Yeah, so yeah.
What about on the short side? Is there something, does an opportunity get created in an ethical fund to short or sell things that you think are A, going to perform badly, and B, that because they don't meet the ethical criteria?
So if you take a step back, and the IPCC climate change report came out the other day, it's fairly well agreed, apart from our government, that to hit the numbers to not get 1.5 degrees of warming, we can't emit more than a certain amount of CO2. Now the problem is, if we continue in our current path, we're going to blow through that. That has all sorts of other ramifications. If we assume that we try to hit it, what does that mean for these businesses? So it has all sorts of interesting outcomes. So high cost certain producers in the energy space aren't going to work under these scenarios. If you price carbon, coal actually may work under certain scenarios. You know, instead of taking coal is evil, coal is bad, whatever, and that, you look for the losers under certain scenarios. So one thing that we've been short this year and done quite well for us is we've been short Qantas. Qantas is obviously a heavy user of oil and fuel, and it provides a nice offset to our portfolio because we don't own any oil and gas. So if oil goes up, Qantas does poorly, but we don't own any other stocks. So it's one way of benefiting from that view. Qantas is about to encounter a regulation change in jet fuel pricing in 2020, which is what you call an ethical change. The UN has changed the amount of sulfur that can be emitted from diesel, and diesel and jet fuel are almost the same in oil refining industry. And that's sending margins up on top of oil price. So we think Qantas is a stock that has issues with being exposed to carbon pricing, has issues exposed to regulation, and we thought it was an overvalued business at $6.50.
Interesting. Chad, I know from reading your articles that you're very big on having evidence to support your views, whether it be on bigger market trends. Is there compelling evidence out there that says ethical investing can add value, or at least keep up with investing that doesn't have an ethical screen to it?
I think the idea that it can't add value is one of the biggest furphies out in the market at the moment, and I think it's spread by people who take it from a I just don't like it view rather than an evidence-based view. Last year we reviewed 50 papers, and some of them is ethical or ESG or SRI, depending which phrase you want to use, do not destroy value, does not destroy value. Now how much value it adds sort of varies by region, by style, etc. and stuff like that. But it doesn't detract just by doing that. That doesn't mean it's always going to add value. That doesn't mean I'm always going to pick good stocks. I can still get stocks wrong, and we often do get stocks wrong. Is that there's nothing inherent in the process that will stop you from making money. Now, I think the best paper we reviewed last year was the people who don't believe in ethical investing go, if you look at tobacco and what they call sin stocks, alcohol, they've outperformed. If you don't own those, therefore you must underperform. I think it's a fallacy of composition. Like, just because you know that, therefore you've made a conclusion that goes to the end, that therefore it must make sense. Yeah. The paper pulled this apart, and what it showed was that's correct. The assertion that sin stocks outperform is true, by the way. But ethical investors tend not to own certain other types of stocks. They may be ethically dubious, but they're not in the sin category. Those stocks underperform. So they naturally own stocks that outperform, call that a tailwind, but they don't own the sin stocks, we call that a headwind. When you stick the two together, you come to a small positive number. Although it's a great paper because it decomposed the issue and showed you how it works. The other way to think about it is, I've got to build a 30 stock portfolio, give or take. If you look at the investable universe, excluding the oil, gas and things that we said we don't own, there's about 900 names of those, which leaves me about 7,000 names in the world. The papers also show, and our experience is the same, building a 30 stock portfolio out of 7,000 names, you're not constrained in optimization. So if I was to try and do it long only in Australian large cap stocks and remove resources and all these, then trying to optimise 30 stocks out of 70 or 60 becomes a very difficult problem. The UBS had a very good paper on the optimisation issue as well. So there isn't any evidence that supports those assertions. And I think investors are right to say you can do good, feel good, and make money.
It's a great headline.
Wish I'd thought of that one.
Chad, we always like to hear about the lessons that investors have picked up along the way. So I'm gonna give you two questions to finish up on. Yep. The first one, a painful investing experience that you've been through that's made you a better investor today.
So for that, I'm going to go all the way back to before I started my professional investing career when I was an amateur investor. So at university, a friend of mine, Tim Searles, who worked with Steve from Forager, the two of them are intelligent investor, we were doing some investing. This is the career we wanted to get into. So Tim's been over with Steve to Buffett in Omaha. You know, we're looking for moats. And we found this business called Melbourne IT. This is going back to 1999. It floated, it was overpriced, we're not going to buy it. In the middle of the dot-com crash, it came back to what we thought was fair value. You know, Buffett always says buy when there's blood on the streets. So we thought, yes, we're going to do this. We bought into the stock and promptly lost 80% of our capital. And the lesson for me there was we caught a falling knife. Melbourne IT still exists today. It's probably never as good business as we thought it was. But it took us 4 years to get back to break even. Time value of money matters. Yeah. So Tim and I are still friends, but I took on more, and Steve has his own investing style. Is for me, that changed me into understanding momentum, i.e. timing matters, time value of money. And that started me down a path to incorporating more what you'd call trend investing into value. I'm never going to be a growth investor, but value and trend are actually possibly the best combination of factors to stick together. And I learned that the hard way by dusting a lot of my PA money before I started.
All right, well, let's finish on a bright note. Can you tell me about a successful investment that you had a rip-screaming, like out of the park investment that you've had, and also the lesson that you took away from that you can learn from your winners as well? What's something that you can repeat from a really successful investment?
So possibly a thing that, and this is true for most investors, is their distribution of returns is they make most of their money out of a couple of stocks and they give it back on the rest, basically. When I was working at Hunter Hall, and this is a little bit how investing works, I met with a broker and we were talking about a stock in the portfolio, and I said, well, is there anything else? He goes, I've got this business called Herbalife. He goes, none of the street like it, none of my clients like it, they all think it's a bit dodgy, but I think this is a great business. Well, let's hear a bit more about this. So this was when the stock was trading at about $15. We looked through it, great returns on equity, really fast growing business, and they were changing their business mix. And one lesson that came out of that, which has been told to me by another friend, Simon Gresham at MFS here in Sydney, is you always look for businesses where you have a small division, a smallish division at say 20 or 30% that's growing at 20%. Because even if the overall business is only growing at 8, if that 20 keeps growing at 20, it's going to accelerate the top line growth of the whole business, but no one's going to value the business correctly. They were switching over their model to the way they did things with shake clubs, etc. and stuff like this. And we met with management. What was interesting about the meeting with management was they'd done all their DD on me. They knew where I'd worked previously, they knew how much money we ran at Hunter Hall. It's very rare to actually do a meeting with management where they've scoped you out beforehand. And what's interesting there is a lot of people still hate that stock. Bill Ackman tried to short it. He's been proven wrong. That was a 4-bagger for us at Hunter Hall. And I probably failed to appreciate that lesson, and I learned it better. It was find a division at 20 or 30% that's changing inside a business, and people don't adapt their expectations quick enough. So if every quarter that came in, the earnings beat. And they go, oh, it can't happen again next quarter. Happened again, happened again, happened again. So the stock just continuously outperformed for the better part of 3 or 4 years. And I think that Bill Ackman giving up on it showed there was actually a genuine, interesting business that had great very high barriers to entry that was not priced correctly. So my lesson there was look for businesses changing, and one of the names of our firm is Morphic, to change.
Great. Well, Chad, always good to catch up. Love having a candid chat, and thanks for sitting down with us today.
Cheers, thank you.